Yeah, let's start. So good morning, everyone. I'm Habei Zhao from Lehigh University, and I'm going to be the moderator for today's seminar. So it's very nice to see many old and new friends getting connected here. So today we have Sehoon Kim from University of Florida presenting a very interesting paper on sustainability preference and mutual fund flows during the COVID-19 pandemic. The participants can type your question in the chat box, and I will interrupt the speaker when appropriate and raise the question for you. So Sihong, you have 75 minutes, and you can start whenever you are ready.
All right, thank you very much for inviting us to present this paper. This paper is co-authored with Robin Deutling at the Rotterdam School of Management, who's also here in the audience today. We're in the middle of revising the paper, so I just want to let you know that there will be some things in the presentation that aren't in the paper yet. And so we're very much looking forward to welcoming your comments. All right, so what are we doing in the paper? We look at socially responsible investing, or SRI, in the mutual fund space, which has exploded within the past decade or so, as you all know. There's been a growing literature trying to explain this. Is SRI viewed by investors as a necessity or a luxury? Are these investments made out of financial considerations or other personal preferences? For example, to make yourself feel better that you're backing a good cause. Is this a resilient market phenomenon, or is there some fragility to it? We think looking at SRI demand around a crisis can help shed light on these questions. If SRI investment flows, for example, stopped during a crisis when the going gets tough, regardless of how they perform, you would think that this was an indication that SRI investments are made more like a luxury consumption. So to do that, we look at the COVID-19 crisis. And this is a unique crisis in a number of ways. One, it started out by exogenously shocking the real economy. Exogenous in the sense that the root cause of the shock had nothing to do with the economy, unlike previous crises such as the 2008 financial crisis. It went with incredible speed, starting out with revenue losses due to quarantines and lockdowns, leading to job losses from layoffs and furloughs, which then led to deteriorating expectations about the future and heightened uncertainty. But all in all, it led to a big impact on preferences for costly but non-essential goods. And second, this is also the first crisis of this kind and of this magnitude ever since the explosion in SRI over the past decade or so. So it's a very natural setting to look at, not just for the sake of COVID per se. So what happened to ESG investing around the crisis? A number of studies have looked at this, and the message is mixed. Some argue that ESG investing is resilient, evidenced by superior returns on assets and robust aggregate fund flows. On the other hand, some show that investors, retail investors in particular, didn't seem to actively allocate their holdings toward SRI around the crisis. So what do we add to this discussion? Well, let me first start by showing some evidence consistent with performer view. Looking at weekly average net flows into mutual funds with different Morningstar sustainability ratings, where we're lumping funds together into one bucket, regardless of whether they're sold to retail or institutional investors, it's actually easy to read this as saying that funds with high sustainability ratings continue the trend of attracting more flows than average or lower rated funds, or at least there isn't a structural break there. This is consistent with past Grand Vorsats or recent Morningstar reports, for example. However, if we want to garner deeper interpretations about the rationales and motivations for ESG investing and study the nature of preferences of such investments using COVID-19 as a setting, it becomes more important to distinguish between different types of investors that operate under different conditions and incentives. For example, between retail and institutional investors. So what we're going to do is focus on retail fund flows as a proxy for revealed preference for sustainability by individuals, as opposed to institutional fund flows, though we will take a look at this too to draw some interpretations later. First of all, retail investors are obviously important in the mutual fund space, as you can see in these figures, comparing total net assets and dollar net flows into retail and institutional funds. And retail flows have been shown to be sensitive to changes in sentiment and preference, lending support to the idea of using these flows to study how preferences are affected by a large economic shock, such as COVID-19. But as I said, we will also look at the differential responses by retail versus institutional fund flows, since their differences can actually say a lot about the channel for what we'll be finding. For example, retail investors have shallower pockets, and they don't have institutionalized ESG mandates like institutions often do nowadays. So this is the key result. Again, looking at weekly average net flows, but this time into retail funds, or in other words, fund shares that are sold to retail investors. You can see that high ESG funds, funds that had 5 Globe Morningstar sustainability ratings as of the end of 2019, we'll get into the details of this later. These funds received higher than average flows before the onset of the COVID crisis. And this is consistent with Sam Hartzmark's JF paper, for example, that showed that the introduction of these sustainability ratings gave a big boost of flows for highly rated funds. But once the COVID crisis kicks in, starting with the week when the stock market started to crash, these differentially high ESG fund flows all but disappear. And what's interesting is that even after the stimulus package was announced in March and the stock market took off again, as we all know, SRI funds never got their full luster back, even though fund flows overall came back. Now, if you normalize flows by taking their percentage rankings within fund size deciles, the picture is even clearer. High ESG funds used to attract a lot more flows, and that disappears and doesn't come back even during the market rebound. Now, I'll show you our actual regressions and what we control for and whatnot, but our takeaway is that this is consistent with a shift away from preference for sustainability by individual retail investors. Well, corroborating that interpretation is this figure of Google search trends, where you can see as the coronavirus was unleashed, interest in sustainability goes down. Search activity for words like sustainability, global warming, ESG, all seem to go down. In sharp contrast, interest in the economy goes up. Search terms like the stock market, furloughs, financial crisis, people become much more interested in these kinds of things rather than things related to sustainability. Now, of course, we want to take this with a little bit of grain of salt. Things like furloughs, for example, is a term that a lot of people haven't heard about before the crisis. So there is kind of a mechanic increase going on here, but hopefully you get the point from the earlier figure where all the ESG terms are going down.
So Sehoon,
yes.
Can I ask a question?
Sure.
So the main result seems to suggest the flows to the high ESG fund are like in a way fragile, right? And
yes.
I'm wondering how much of the result is driven by the difference in the load fees? Because I checked the Morningstar data yesterday. So within the institutional share classes, pretty much nobody charges the load fees. Within the retail guys, if you look at the low ESG rated funds, 19% charge the back-end load fees. Within the high ESG rated funds, only 14% charge the back-end load fees. So if they don't charge load fees, I mean, people would redeem during the crisis.
Right, that's a good question. So in all of our analysis, we'll be controlling for observable features of funds like fees. And later on, I'll also show you a direct formal comparison between retail shares and institutional shares sold by the same fund and controlling for their differential fees. So we interpret this as not being driven by features like fund fees.
Okay.
Well, I'll come back to that.
Next.
Okay. All right, so now, as I've said before, and as I've been just saying, we also do look at SRI fund flows by institutional investors, or flows into fund shares offered to institutions. And the picture is very different. If anything, SRI flows are pretty stable. And there's a relative decline in flows into funds with the lowest sustainability ratings, but even that comes back somewhat. And so if you look at normalized flows, there's not that much difference in which funds attract relatively more flows from institutions, which are the high ESG funds. So given that institutions are deep-pocketed and often have explicit ESG mandates baked into their charters, you would naturally expect, if SRI demand were indeed something like a luxury good, it would primarily be the more granular and shallow-pocketed retail investors whose preferences would get hit as they get hit hard by the economic shock imposed by COVID-19, but probably not the publicly ESG committed institutions. And that's exactly what we're finding here. So this response heterogeneity and a lot of other evidence I'll present are consistent with the idea that individual preferences for sustainability are a preference for luxury that becomes unaffordable during bad times. Consistent with this idea, these flow responses are more pronounced in countries with more stringent lockdowns, weaker economic support, and lower economic growth after COVID. I'll also talk about what we do to rule out these alternative explanations, including what Haibei just raised, and also some additional tests making the retail versus institutional contrast more formal, as well as an examination of how ESG fund flows evolved during weeks when the majority of US states started reopening their economies after prolonged lockdowns. Now, an implication of what we find is that retail fund flows pose a source of fragility in SRI investing. In the long term, the externalities that retail demand could have on institutional motivation and how effective their ESG ownership and engagement are could mean that SRI demand might be more fragile than you think, especially when there's prolonged economic distress.
Sehoon, we have a question from Yuehua Tang.
Yes.
Is it possible that the results on retail flows are driven by COVID-related disruptions to the broker channel of selling these funds to retail investors, especially? It might not be reflecting the investor preferences.
That's an interesting point. That we have not thought about that, but we will. That's an interesting point.
Okay. And another question from Sugata Ray. Perhaps the retail investors in the SRI funds are different than the average retail investor. So maybe you have a different investor clientele, for example, which have higher liquidity needs.
That's entirely possible. Now, it would be great if we could know what the composition of retail investors were in these funds and other funds, but unfortunately, we don't have that information. So that is possible, but there is really no way for us to directly examine that, unfortunately. But that's a good comment.
For the liquidity needs point, specifically, maybe you can look at the other shocks, like in the past,
right.
2008, 2007, if it's purely a liquidity story. I mean, this is just my 2 cents.
Exactly. Yeah, that's a very good point. So actually, we're in the midst of trying to collect older legacy data for these sustainability ratings for an earlier sample period. Unfortunately, the data doesn't go back that far. Actually, it only goes back as far as 2018 as of the version of the data that's available through Morningstar right now. Although they do seem to have legacy data going back as far as 2016. And so what we could do is try to get that data and look at some interesting shocks that happened prior to COVID. One thing that we're thinking about is looking at the months where Bitcoin experienced an extreme surge, trying to use that as sort of a placebo test to see if what we're finding is just not a manifestation of shifting interest due to hotter investments. But that's in the works. But you're definitely right. It would be really good if we could go back in time and look at other shocks as well.
Thank you.
All right. Where was I? All right. So our paper primarily contributes to the recent growing literature on SRI and ESG investing. But more broadly, we also contribute to the broader literature on CSR and ESG, and also the recent explosion of papers studying the financial consequences of COVID-19. And I'm listing very few papers here. There's not enough space, but as you know, these are very extensive literatures. In fact, the finance community's work on the implications of COVID-19 only since early this year has been so swift and so vast that you could probably make a couple of handbooks out of them already. But anyways, that's the paper in a nutshell. So you already have the key takeaway. So let me move on to the details of the paper. All right, so all of our data comes from Morningstar Direct, which includes information on fund flows, returns, net assets, expense ratios, Morningstar star ratings, global fund category, or in other words, investment style, age, and a retail institutional share class flag. Now, really important for us is the Morningstar Sustainability Rating, which is based on monthly moving averages of the previous 12 months portfolio level weighted average sustainability score, where the holding level or stock level ESG risk scores come from Sustainalytics, which Morningstar recently acquired. Based on these scores, funds are then sorted into buckets of 5, 4, 3, 2, or 1 globe ratings, 5 being the best in terms of the fund's exposure to unmanaged ESG risk. These sustainability ratings are also salient pieces of information that are publicly and readily accessible to retail investors through Morningstar's website. For example, if you look up Trillium ESG Global Equity Fund in the portfolio section, you can very easily find this very saliently designed sustainability rating. And investor fund flows have been shown to be responsive to these ratings. So based on that information, here's how we construct the sample. So we start with all US domiciled open-end equity mutual funds. So for now, we won't be looking at international funds like European ones, which are important, but we will sort of get to that later. Since we're gonna be using daily data to aggregate to weekly, there needs to be at least one non-missing daily flow value during the week. And we exclude funds with less than 80% of their assets invested in equity. And we also exclude funds with less than 5 million in total assets, following standard screening procedures used in the literature. Now, an important thing to note is that funds come in different share classes. And what we do is aggregate share class information at the fund or portfolio level. Specifically, we sum up total net assets and dollar net flows across share classes. We take the average of returns and expense ratios. We take the oldest share class for age and style. We take the largest share class for the sustainability rating. Again, this is all just following intuitive procedures done by previous papers. Now, if the fund offers both retail and institutional share classes, we'll aggregate at each of those levels as if the retail shares and the institutional shares comprise 2 different funds. Now, of course, most of their fund characteristics would be the same, maybe aside for fund flows, net assets, and expenses. Now, at the end, we have a little over 2,700 retail funds and 2,400 institutional funds. And we're going to be focusing on the retail funds for the most part. The sample period runs from the beginning of the year until April at weekly frequency. But toward the end of the presentation, I'll also show you some results from extending the sample period further to include weeks when states around the US started loosening lockdowns and started reopening their economies. So to show you the biggest gun first, this is our diff and diff regression. The dependent variable is weekly fund flow, and we'll use either net flow as a fraction of the previous week's total net assets, or normalized net flow, which is the within fund size decile flow percentage ranking. We regress fund flows on high ESG or low ESG dummies for whether the fund had 5 or 1 globe ratings as at the end of 2019, and their interactions with a post-COVID time dummy. And I'll show you 2 sets of COVID dummies. One setting where we have just 1 dummy for all the weeks ending February 22nd or later, and another setting where we have 2 separate dummies for the earlier market crash period and the later post-stimulus market rebound period. And we'll also have a bunch of controls as well as style by week and vintage by year week fixed effects. So here are the results. So you can see that while high ESG funds in the 3rd row receive higher than average flows prior to the crisis, this flow advantage basically disappears after the crisis begins. Now, magnitude-wise, if we look at the 2nd column, for example, high ESG funds, though they normally receive 0.14 percentage point more flows than average, and that's per week as a fraction of total net assets, during the crisis, they end up getting 0.2 percentage point less flows per week, and that's a sizable amount. Now, this is true if we control for past month's return, past year's return, their interactions with the COVID time dummy, log TNA, expense ratio, upgrades or downgrades in the Morningstar star rating, the level of the star rating, its interaction with COVID, and style by week, as well as vintage year by week effects. So things like fund style, size, age, past performance, star ratings, expenses don't seem to account for the fact that retail investors seem to be investing disproportionately less in funds with high sustainability ratings. And what's more is if we separate the earlier crash period between the weeks ending February 22nd, March 21st, from the later rebound period between the weeks ending March 28th and April 25th, we see that this result persists beyond the market crash period and into the period where stock markets recover remarkably. Now, given the real economy continued to deteriorate in the 2nd quarter, our results are consistent with the real economic downturn impacting retail investors' decisions, rather than investors simply buying into low ESG funds, which underperformed high ESG funds during the early dip. And I'll show you some return regressions later to make this point a little bit clearer. But if anything, the disproportionate decline in retail SRI flows is even stronger in the later post-COVID period.
So Sehoon,
yes.
I think there's a question from Shugata about the previous slide, number 17.
Sure.
Why there's a positive link between flow and size, total net assets?
Why larger funds receive higher flows?
Yes.
Can you give a little bit more context about the question?
I guess usually people regress the flow on the. Oh, okay, go ahead.
Yeah, generally, every flow to size relationship I've seen is that larger funds get lower percentage net flows. Are these dollar flows, or maybe you're using contemporaneous size, in which case they're going to be mechanically correlated?
These are lagged total net assets, and the flows are scaled as a percentage of total net assets. So it's not going to be, it's a good point. Well, the total net assets, I was thinking that you were talking about, you were thinking about the diminishing returns to scale. But, you know, in terms
that's
of,
exactly what I'm thinking about. If you have a $10 billion fund, it's harder to get a percentage net inflow than a $100 million fund.
Right. But these aren't returns, these are flows, so it's a little bit different. So you could think of size being correlated with, for example, reputation of funds. So usually there's going to be some concentration in terms of which funds attract more investors in general, and the ones that have are better known to investors usually attract more flows, and these are usually the bigger funds. So I would think of it in that way. I think in terms of the return to size relationship, that should be indeed concave or diminishing.
So the size is lagged.
Yes.
Okay. Maybe it's because I'm wondering, is it because of the weekly frequency you're using? I'm not sure. So just.
Yeah, that could also be it, and it could also be that we're looking at so many different things here. I wouldn't know what the effect would be if we just regressed weekly flows on lagged total assets itself. So that's something that we could check. But thanks for the comment. We'll check on that. All right. Okay, so now that we saw the diff and diffs, let me peel down the flow dynamics for you. So here I'm showing you period by period. Sorry, oh, actually, I skipped a slide. Okay, so what's more, if we separate the earlier crash period between the weeks ending February, did I already talk about this slide? Yes, I already talked about this slide. Okay. Now that we saw the diff and diff, so let me peel down the flow dynamics. So here I'm showing you period by period, sort of a cross-sectional comparison of how high ESG, or in other words, 5 globe funds, above average 4 globe funds, below average 2 globe funds, and low ESG funds fared in their flows relative to the emitted average fund during each of the pre and post-COVID periods. Now, what you can basically see is that funds with high or above average sustainability ratings received higher than average flows before the crisis, but then after the crisis, they just became like the average fund, even as the market rebounded. If anything, it was the low ESG funds that received higher than average flows during the rebound, not the high ESG ones. Now here's a more statistically straining, sort of shooting myself in the foot kind of figure, where we ran week by week regressions of flows on the high and low ESG dummies, controlling for all the variables we saw before and all the fixed effects as well. And we plotted the coefficients on the high and low ESG dummies. Though maybe not as clean as the raw averages I showed you at the beginning of the presentation, you still see the pattern of high ESG funds losing their luster around the crisis. Even more on the dynamics, now I'm going to show you how funds in each sustainability rating group did before and after the crisis in the within rating time series sense. So first you can see that overall retail fund flows declined after the crisis hit. But there's a remarkably monotonic pattern in who gets hit the worst. The high ESG funds see the biggest decline in flows, and the low ESG funds see the least decline. Now, if you look at the early crash and post-stimulus period separately, the results are even more interesting. While on average, funds recover their flows swiftly after the stimulus is announced and markets recover, high ESG funds recover the least, while low ESG funds recover the most. And that relationship between fund sustainability ratings and their flow recoveries during the rebound period is also almost monotonic, but in the opposite direction from the initial decline. In other words, the higher your sustainability rating as a fund, the harder you get hit as the economy tanked, and the least you recovered as the market rebounded while the economy continued to deteriorate. Okay, now that we've established that high ESG funds suffer bigger declines in flows, the next question is, does this really mean that there are outflows from SRI funds? And this is important in the context of thinking about the implications for the fragility of fund flows. So what we do here is replace the flow dependent variable with a dummy for whether net flow is negative. In other words, a net outflow dummy. And what we find is indeed high ESG funds experience a much higher likelihood of seeing outflows during the crisis relative to pre-COVID likelihoods compared to other funds. During the crisis, these funds are 6 to 7% more likely to see outflows during the early market crash, and 9% more likely to see outflows during the rebound compared to other funds. So yes, high ESG funds do experience a greater risk of outflows during this pandemic crisis.
So Sehoon, we have a question from Luke Pastor. A very interesting paper. You pull active and passive funds together, right? Are there meaningful differences between flows into active versus passive mutual funds?
That's an excellent question. Later on, we'll try to tease out whether there's an element of investors changing their preference for passive versus active funds around the crisis. And we do find some evidence that investors seem to be flowing more toward index funds around the crisis, but controlling for that effect, it doesn't seem to be subsuming the results that we are finding. But we haven't actually looked at the composition of ESG funds, whether they're more active versus passive. That's something that we can look at. But later on, we'll show you a little bit about the active versus passive aspect. Thanks.
Okay.
Okay. All right, so now we turn to the question, what channels might be driving these results? Although the COVID-19 shock is arguably a sharp economic shock, and though we are already sort of setting a pretty high bar in terms of controls and fixed effects, you might still worry that there may be channels other than a reduction in luxury demand that could explain the ESG flow results. So, for example, there could be shifts in preferences for active versus passively managed funds, like I just mentioned. So here we start by presenting some evidence that can be interpreted in our favor to begin with. So to do this, we're going to be deviating from our focus on US funds and extend to a global sample of all open-end mutual funds around the world. Now, first, just some robustness, showing that our baseline results hold for European funds, all funds domiciled outside the US, and all funds around the world. Basically, the message is that our results are robust across these international samples. Hence, what we're finding is not just an idiosyncratic phenomenon within the US. Now then, using this global sample, we're going to exploit some important cross-country heterogeneities relating to how bad their economies were hit by COVID. We exploit the Oxford COVID-19 Government Response Tracker, in short, OXCGRT, which is a project by the University of Oxford's School of Government that collects publicly available information on several, I think, 18 or so indicators related to governmental responses to COVID-19. Or I think by now they have data for around 180 countries. And these indicators include things like school closures, restrictions in movement, restrictions in travel and business, economic stimulus policies like direct income support or debt relief, health system policies, and so forth. They then package this information into response indices. And among those indices, we use their economic support index and restriction stringency index and sort countries into high or low buckets with respect to the median, and then conduct subsample tests based on the idea that countries with low economic support compared to high economic support, or countries with stringent rules versus laxer rules, would have been hit worse by the pandemic, economically speaking. If our interpretation is correct, then it would be in those countries where you would expect to see the ESG fund flow reductions the most. We also use a simpler method of sorting countries by their GDP growth rate instead during the crisis to test similar hypotheses. Now, what these results are telling you is basically that funds sold in countries that had more stringent restrictions in place, countries that didn't have a lot of economic support, countries that had lower economic growth saw more of an SRI exodus among retail investors. This is significant both in subsample comparisons as well as in pooled regressions with triple interactions instead.
Sehoon, we have a question from David Kakowski. It would help to know about ESG ETFs also, and how much of this is unique to BlackRock's push to ESG, which appears to be directing flows to BlackRock's ESG ETFs.
Right, so here we're only looking at open-end mutual funds. I think at some point we did try including ETFs as well, and I think the results were similar. I think my co-author Robin is in the audience. He might have a better idea of what that pattern looked like. I think he did the exercise. But in this study itself, we're just looking at open-end mutual funds. We don't have ETFs.
So I think another follow-up question to Lou Pastor is the one difference between the active versus passive is for the active guys, you can change your portfolio holdings actively, right? So right. You can see if the fund managers change their portfolio, right, stocks towards those stocks which have more ESG oriented features.
Right.
So during
okay. Okay, so let me refer that question to the next slide, actually. So,
okay, sure.
Okay, so that's an excellent question, and I think that's sort of where we're heading. So okay, now that we've seen some evidence, corroborating our interpretation, obviously there are these alternative explanations as well. So now let me show you some more tests that will hopefully convince you against these other alternative explanations. So this is another robustness test. Making sure the results aren't driven by ex-ante differences across funds in risk-adjusted returns, fund risk exposures, or past flows as a proxy for popularity. So in the first panel, we're sorting funds into quintiles based on their previous month's Fama-French 5-factor alphas, which are calculated on a rolling basis using past 12 months returns. And then within each alpha quintile, we sort funds into high or low ESG using the raw historical sustainability scores that form the basis of the globe ratings. So if you look at the pre-COVID and post-COVID periods, the message is that a big and significant fund flow advantage that high ESG funds used to enjoy disappears after the crisis hits, both within and across alpha quintiles. Now, in the bottom two panels, we repeat this exercise using rolling window betas, or past 12 months flows instead of alphas, and basically show that the results also are not driven by cross-fund differences in market risk exposure or past popularity either. Now, I don't think this directly answers Luke's question, but we are using sort of rolling window betas, for example, in panel B, that are changing over time depending on which time period we're looking at. So you could say that if funds were changing their investment strategies over time and they were changing their risk exposures over time, you would see that their ex-ante betas before we measure their fund flows would affect the extent to which high versus low ESG funds receive more flows. But that doesn't seem to be the case here. Now, a little bit later, I'll show you another regression basically trying to show you that if we directly control for the interaction effect of betas and the COVID time dummy, basically trying to get at the fact that investors, on the other hand, could be changing their perspective in terms of which beta funds they want to invest in. That also doesn't seem to be driving our results. But I think to get to your question a little bit more directly, we want to go to the holdings data and sort of look at individual stock level betas and sort of back out the fund level betas to look at whether they're holding composite betas are changing over time. But that's something that we haven't done yet. But hopefully it sort of gets to that flavor a little bit.
Yeah, my feeling is that, I mean, during the beginning of the pandemic period, these high ESG stocks seems to better perform, right? So
Yes.
you're showing the high ESG mutual funds are not underperform, but it seems the investors are not in favor of these mutual funds.
Yes, exactly.
Yeah. Anyway,
exactly.
So we have a question from Blair or Seth on a different point. This is a great extension to dig deeper in the economic distress channel you've posited. Have you considered any high frequency measures for economic health, for example, weekly insurance claims in the US?
Oh, that's a great suggestion. We'll definitely do that.
There might be some state level variations also.
Yes.
In terms of economic.
There should be, definitely. Thanks, Blair. All right. Any other questions? Okay. Okay. So far, we already sort of saw that our results are probably not driven by investors dashing into the temporary stock market crash. As we saw the high ESG exodus continue into the rebound period as well. But we do an additional test here to rule this out, using weekly fund returns as the dependent variable in our otherwise baseline different diff. And what we find is exactly what Haibei was talking about a minute ago. What we find is that unlike fund flows that are persistently lower for high ESG funds during the entire crisis period, their returns, on the other hand, are higher only during the early crash period. But then their returns are actually lower than average during the rebound. And conversely, low ESG fund returns are only mildly lower than average during the crisis, but then much higher during the rebound. And what's more, when we control for the interaction between past returns and the COVID dummy, so what that's doing is trying to control for return persistency. There's a possibility that return persistency could change around COVID, and we're trying to control for that. And the return results actually go away when we do that. And this is in contrast with our flow results, because the flow results were actually robust doing this. So in other words, it doesn't seem like a contemporaneous return chasing story, like buying the dip, can fully account for our results. Still, one might argue that there could have been other structural changes around the COVID-19 shock that may coincidentally result in lower flows for high ESG funds. For example, structural shifts in fund performance or the sensitivity of flows to performance, shifts in risk exposures or investors' risk preferences, shifts in investor appetite for passive versus actively managed funds, like I was talking about before, or shifts in attention towards certain sectors like healthcare or tech. After directly controlling for the shifts in such factors around the COVID period, however, we don't find that any of these actually subsume the ESG flow responses to COVID. For example, to ensure that shifts in performance-related factors aren't driving our results, we directly control for the fund's performance during the entire COVID period or just during the market crash period, along with their interactions with the COVID time dummy. To ensure changes in risk preference or exposure aren't driving the bus, we control for the fund's rolling market beta and its interaction with COVID, or whether the fund is an index fund to capture changing preferences for passive investing, and also shifts toward healthcare or tech sectors that have attracted a lot of attention after COVID. Now, while there's no doubt that some of these channels have been at play, but the important thing is they don't seem to be driving our results. Another alternative explanation still could be that mutual fund companies have recently been setting up increasingly more ESG funds that impose more competition for flows. And that basically erodes the flow advantages that high ESG funds enjoy. Now, this doesn't seem to be a likely culprit, given the decline in fund entries and increase in fund exits around COVID that has led to a decline in the number of high and low ESG funds alike. Finally, well, not finally, but we also look at institutional fund flows to get a grasp at the channel that might be driving the retail results. As I mentioned earlier, institutions are much less financially constrained than individual investors, and nowadays often have public commitments in the form of ESG mandates. So their investments in ESG go beyond simple taste or preference. So you would think if it's indeed the COVID-19 economic shock that is inducing financial stress that in turn dampens sustainability preference, you should see those results through retail fund flows, not institutional ones. And consistent with this idea, we find none of our aforementioned results when we repeat the analysis with institutional funds. We do see cross-sectionally that high ESG institutional fund flows relative to the average goes down during the crash period, but this decline is actually much sharper for the low ESG fund flows, and both essentially reverse during the post-stimulus market rebound. If we look at each sustainability group before and after COVID, you basically see no visible decline in flows for high ESG funds, but a sharp reduction for low ESG funds during the market crash. But during the rebound, if anything, institutions pour more money into high ESG funds, but not into low ESG funds. So these are clearly different from the retail flow responses, but are these differences significant? We test that by pooling the retail and institutional funds together and augment our diff and diff by further interacting a retail dummy. Now, the cool thing here is that because there's a large number of funds offering both retail and institutional shares, we can even include fund by week fixed effects, basically to wipe out any effects coming from the portfolio level. And what you see is that indeed retail SRI funds experience a sharper and more significant decline in flows in response to COVID compared to institutional ones, controlling for virtually every aspect of the fund's portfolio. Not shown here, so related to Haibe's earlier point, we do still control for expense ratios, fund size, as well as the interactions between past returns and the retail dummy, as those kind of things can still be different across share classes.
We have a question from Blair. Do you have
Yes.
any sense for whether E, S, or G is the dimension of sustainability that retail investors de-emphasized? For example, do you know what your flow regressions would look like if you replaced the sustainability globes with E, S, G percentile ranks?
Right. We sort of started looking at that a little bit. Now, the caveat is we only seem to have sort of the most recent information for the percentage ranks. So we don't have a full time series of that. But from a preliminary look at the data, we do seem to see that the effects are concentrated in the environmental aspect among ESG. But we'll have to do a little bit more to make sure that these results are actually robust. But we do have some preliminary results in the back. And they do seem to manifest mainly through E.
Another question from Lucas Pastor. The retail versus institutional difference is particularly interesting. Why do institutions behave so differently from individual investors? After all, institutions manage individuals' money, so they should presumably act on behalf of individuals.
That's a terrific point. Now we think that institutions, at least on the surface of it, they have ESG mandates baked into their charters. So I think they actually have less flexibility in terms of how they can veer their investment strategies in a completely different direction. But we do think what you just suggested has important implications. Well, I'll talk a little bit about this in the conclusion, but we think our results do have implications for the bigger picture as well, including institutional ESG mandates and engagement efforts. Because as you just mentioned, institutional investors serve retail investors as clients at the end of the day. So in the long run, we do think in the face of prolonged economic stress, retail flows and the expression of retail preferences should have an impact on institutional strategies as well. And that actually implies that these retail responses have important implications in the long run. So that's a really terrific point.
I think it sort of related to my earlier comment about load fee, because within the institutional share classes, there's really no difference in the load fee. Nobody charges load fee at all. But within retail, there's a difference which can potentially explain your finding. I know you control for the management fees, but
right. Yeah.
About.
We'll take a look at that.
We also have a question from Vikas Agron. The charter explanation cannot perhaps explain why institutional funds withdrew capital from low ESG funds during COVID. Was there any change in the mandate?
That's a good question. We can actually take a look at whether there were changes in the mandate. Now, I would think that if you actually look at the graphs, right? If you look at the graphs that I showed you at the very beginning of the presentation, you do see a drop in institutional flows towards low ESG funds. Yeah, that's a good point. We'll have to look a little bit deeper into that. We haven't looked at whether there are changes in institutional mandates over time around the crisis. Yeah, but that's something that we can look at. That's a good suggestion.
Okay, thank you.
Yeah, thanks. All right. So finally, we do a sample extension exercise in the time series. So we collect a little bit more data for the weeks after May, when states in the US start to reopen their economies after a prolonged lockdown. Now, around this time, employment starts to stabilize after having plummeted in the months before. And so you would expect, if what we're finding is a preference shift induced by a binding economic shock, during this reopening period, the high ESG fund flows should start to come back. On the other hand, if it's just a manifestation of retail investors just switching their attention to investing in Tesla, for example, then you shouldn't see high ESG flows coming back during this reopening period. But that's exactly what we find. So if you look at the coefficients, we no longer have a negative coefficient during the reopening period for high ESG funds. Okay, so let me conclude. We find a sharp and negative response by retail SRI fund flows to the COVID-19 crisis. Now, our interpretation is that when the going gets tough, sustainability falls off the top of the investor's priority list, and this poses a source of fragility for SRI mutual funds, which, as Lubosh was just suggesting, could have long-term implications for ESG and SRI more broadly if there are potential externalities of retail flows on institutional mandates as well. But we'll have to look at, I think it would be worth looking at institutional mandates themselves, as Vikas was suggesting. So thanks for that comment. Okay, so let me stop here. Thanks a lot for your time and for your comments. These are all extremely helpful.
All right, so is there any further questions from the audience? I'm gonna leave this on for a few minutes in case anybody wants to talk more about the paper. I will stop recording now and thank everybody. Thank the presenter, Sehoon Kim. Thank all the participants for the great questions. Happy holidays. Thank everyone.
Happy holidays.
Bye-bye.
Hopefully we have a better year in 2021.
Yep.